Japan's economic boom is often described with one phrase: the Japanese economic miracle. But calling it a miracle can make it sound like something that simply happened to Japan, like the country woke up one day, wealthy, industrial, and globally dominant. The real story is more precise and, honestly, more interesting. Japan rebuilt with strategy, timing, and relentless focus, and it did it so fast that the transformation became visible in a single generation. Start with the scene after 1945. Japan had suffered massive destruction during World War II, and the post-war years were defined by scarcity and reconstruction. Yet within a few decades, the same country would be shipping cars and electronics across the planet, pioneering infrastructure that looked like science fiction, and climbing to the top tier of global economic power. A key early accelerator was the Korean War. During that conflict, procurement orders for goods and services flowed to Japanese suppliers, injecting demand into Japanese industry and helping pull the economy into recovery. This mattered because it didn't just provide money, it provided momentum, production experience, and a reason to modernize capacity quickly. By the mid-1950s, Japan was entering the most famous phase of its rise, the high-growth era. Britannica describes growth in this period as extraordinary. Annual growth averaged about 10% from 1955 to 1960, and later climbed to more than 13%, reshaping all sectors of Japanese life. That isn't just a statistic. It means incomes, cities, consumer habits, education, and expectations were all moving at high speed at the same time. And crucially, this wasn't an open-ended upward line forever. Britannica notes this era of rapid growth ran up to the 1973 oil shock, when the OPEC embargo marked a major turning point for Japan's model. So what was the model? Part of the answer is that Japan pursued growth as a national project with coordinated policy, industrial development, and export power. In the 1960s, two forces stand out. First, a consumer economy was encouraged by Prime Minister Ikeda Hayato's income-doubling plan in 1960, which symbolized an ambition to raise living standards and expand domestic demand. Second, industrial policy was shaped by MITI, the Ministry of International Trade and Industry, an institution often associated with Japan ORI's post-war development approach, and its focus on building globally competitive industries. But the boom wasn't only domestic. Japan leaned hard into exports. Britannica notes that during the 1960s, Japanese exports expanded at an annual rate of more than 15%, and that by 1965, Japan showed the first signs of a trade surplus. This is one of the clearest fingerprints of the boom. The country wasn't only producing more, it was producing things the world wanted to buy at scale. Over time, Japan became a world leader in industries that would define late 20th century life. Shipbuilding, electronics, steel, automobiles, and high technology, adapting its industrial output to global demand. This is where the economic story becomes visible in everyday life. Economic booms can sound abstract if they're told only through GDP and trade balances, but Japan's boom came with symbols that people could touch and ride. Physical infrastructure that expressed speed, confidence, and engineering discipline. The most famous of these is the Shinkansen. Japan's first high-speed rail service, the Shinkansen, launched on October 1, 1964, linking Tokyo and Osaka, and it opened just ahead of the 1964 Tokyo Olympics. The plan behind it had been approved by the Diet in 1959. The Embassy of Japan in the UK explains that the Shinkansen was conceived to solve capacity shortages on the Tokyo-Osaka corridor that were being driven by rapid economic growth. In other words, the boom created pressure, crowding, movement, demand, and the response was to build something new, something faster, something that matched the pace of national ambition. For many outside Japan, this is the moment the country's resurgence becomes undeniable. A nation that had been associated with wartime devastation was now presenting itself through precision infrastructure, global events, and modern technology. The Shinkansen wasn't just transportation, it was a statement. Japan could build systems at scale, on time, and at the frontier of what was possible. Still, every boom has chapters, and Japan's story doesn't end in the 1960s or early 1970s. The oil shock of 1973 changed the environment, and Japan's growth model had to evolve. Over time, Japan remained a major industrial and technological power, but the tone of the story shifts again in the 1980s. That decade contains the prelude to another famous term, the bubble economy. By the mid-1980s, the narrative increasingly includes finance, currency values, and asset prices, not only factories and exports. A major turning point in the widely discussed bubble timeline is the 1985 Plaza Accord. Wikipedia, Bao's Asset Bubble Overview, notes the Plaza Accord occurred in September 1985 and describes a sharp strengthening of the yen in late 1985. In many accounts, that appreciation and the policy environment that followed are connected to the late 1980s surge in asset prices. Japan's boom story becomes more complete and more dramatic once it reaches the stagnation era, usually called the lost decades, when growth slowed after the early 1990s collapse of the asset bubble. The key thread to add is Japan did not simply run out of momentum. It was hit by collapsing asset prices, banking sector damage, and a long unwind of debt that weighed on investment and demand. By the late 1980s, Japan looked unstoppable, but the foundation was shakier than it seemed. The boom of that era was increasingly fueled by stock market and real estate speculation and reckless lending, and when the bubble imploded in the early 1990s, it left behind insolvent banks, pessimistic consumers, and deep, persistent problems. Then the numbers turned brutal. The IMF notes that Japan's stock price bubble burst in 1990, and by mid-1992, equity prices had fallen by about 60%. The IMF also reports land prices began falling about a year after stocks and kept declining through the 1990s and into the early 2000s.